Are we buying these dips? And was Friday enough of a sell-off to get people interested?
I'm not. I think today's rally is a little bit disappointing to me. It had two things going for it. One was that, on both the last two Fridays, we trade very heavy because, the risk coming up of the 2 days off. And it would stand to reason for me that on Mondays we should take some of that back. And to take 13, 14 points of it back in the S&P is not quite good enough. Plus, there was a fairly large injection for China, and we still only have a little bit. Now, one thing that I want to point out is that when something like this comes at an all-time high, the pandemic scare, the coronavirus, the stock down move is started by that, but then it kind of can easily morph into just a personal reassessment of risk. I'm not just on the personal level, but on hedge fund level as well. Like, wow, we had too many stocks. And that's the second leg of the correction. And I think if I see weakness any of the next 2 days, particularly if it takes out Friday's low, I think we could be in 7 to 10% correction in the cards.
All right, so 7 to 10% correction, it doesn't happen very often. It certainly hasn't really happened over the course of the past 18 to 24 months all that much at all. So is there an opportunity, if it were to happen, to then put a shopping list together? If so, Jim, what goes on that shopping list? Is it energy? Is it materials? Is it tech and comm services? Or do you just go towards utilities and consumer staples, the dividend payers?
First of all, not only does it not happen very much, it doesn't happen enough. A 7 to 10% correction every once in a while is good and healthy trimming of the hedges, so people don't just get too bulled up and forget about risk. When that happens, I will look at the things that have been the most predictable, and that's technology probably. Energy, I like what you're saying with energy. Oil prices have been kept down so low because of what's going on domestically here, but it's been several years since we've had any bang for the buck there. I think that some of those dividend payers, I've bought some of those already. I think they probably suffer in the correction as well. But those are going to be juxtaposed against interest rates, where if we correct 7 to 10%, you can bet that the 10-year is going to go lower.
The technology sector, we're showing that chart to viewers right now. Big declines on Friday. As you would expect, it was a big leadership type sector in 2019. Mega cap technology and communication services have been a huge driver of the market rally. Are those on the shopping list as well if we see a broader pullback like we've seen over the course of the past couple of days?
If the big global names get hit really hard because this is a big global story, then yes, I think so, absolutely. I think that you also mentioned things like utilities and staples. I don't think they're going to get hit very bad if we do have a 7 to 10% correction. But things that do pay a dividend, like the global players, the energy things, and technology, those will be on my shopping list for certain.
All right.
By the way, too, how about gold and 10-year as well,
I was just going to go there. This is perfect, because I was just going to ask you, do you then stick with gold and long-term treasuries?
Yes, because the one thing the Fed has showed me is that they react very quickly to any sort of market stress. And God forbid they ever mention asset prices, but I believe they're looking at that very closely, too. And I think they get scared when stock starts to decline. So those things like gold and 10-year, I'm long those already and plan on staying that.